Hi, my name is Christian Waldegrave, Head of Research at Teekay, and this is our conventional tanker market update for November 2016. Well, we're now quite far into the fourth quarter of the year, and we're starting to see that seasonal uptick in rates that we normally see during the fourth quarter. Certainly rates are a lot higher than they were during the third quarter, when in August we saw the lowest tanker rates for almost 3 years. And the recovery in rates has really been evident more on the big crude tanker sizes, the VLCCs and the Suezmaxes. In October, the VLCCs have averaged about $35,000 per day, and the Suezmaxes have averaged about $20,000 to $25,000 per day, whereas the AFRAMAXes are still kind of in the mid-teens range. But as I said, that is a lot higher than we were in August, and there's a few things that have spurred that increase in rates. Firstly, as I said, is the normal seasonality starting to kick in. Refineries are starting to import more crude as they ramp up production ahead of peak winter demand. For the big ships, the VLCCs, we've also seen very strong imports into China. Chinese crude imports were a record 8.1 million barrels a day in September. And that's been driven by a couple of things. One is very strong demand from Chinese refiners, both for domestic demand, but also to fill their product export quotas for the year. We're also seeing continued stockpiling in China. And the third reason that Chinese imports have been high is that domestic crude production has been falling. In fact, Chinese crude production in September was the lowest for 6 years. So they're having to import more crude to cover that shortfall. And the big size ranges are also being supported by very high Middle East exports as well, from Saudi Arabia and Iran and Iraq and so on. For the mid-sizes, the increase in rates that we've seen in the last month or two has really been driven by a recovery in Atlantic Basin production, especially from Nigeria. Nigerian production over the summer had fallen to a low of 1.4 million barrels a day due to a series of attacks on the infrastructure there in the country. Since then, we have seen a number of those crude streams come back online. Some of those force majeures have been lifted. And Nigerian production is now back up to 1.8 or 1.9 million barrels a day and is expected to increase a little bit further towards the end of the year. And that's all good for Suezmax exports especially. We've also seen recently an increase in Libyan crude exports. Libyan production and exports have been hovering about 0.2 to 0.3 million barrels a day for quite a while. But just recently they've reopened a couple of ports in Libya and are starting to export more crude, and they're now up to about 580,000 barrels a day. So that's good for AFRAMAXes in the Mediterranean. And we're also starting to see the first few cargoes from the giant Kashagan field in the Caspian Sea. This field has been delayed for many years, but we are now starting to see the first cargoes emerge. Pretty small volumes, but we are seeing them starting to be loaded from the Black Sea and the Baltic as well. So a small boost there for Suezmaxes and AFRAMAXes as well. As we go deeper into Q4, we think that, again, normal seasonality will kick in. The weather gets worse, the daylight hours get shorter, and that should result in more vessel delays, which tends to tighten the vessel supply and give a boost to rates. And we also see that the refiners will continue to increase their imports as they ramp up production for peak demand. For the mid-sizes, again, I think we should continue to see more production from the Atlantic Basin, which will be positive for the AFRAMAX and Suezmax. There are some uncertainties there. We have just seen in the last day or two that there's been another attack on a pipeline in Nigeria. Not sure yet whether that's going to cause any outages, but it does show that the situation in Nigeria is still volatile. For the big ships, the VLCCs and the Suezmaxes as well, all eyes now are on OPEC and what they will decide to do at their next meeting at the end of November. A couple of months ago, OPEC said that they had agreed in principle to a cut in production to between 32.5 and 33 million barrels a day. That's versus current production of 33.6 million barrels a day. They are now discussing how they can achieve such a cut. And if they can come to agreement, it will be announced at their meeting on November 30th. But there are a lot of question marks as to whether they can come to an agreement. We understand that Iran, Nigeria and Libya have argued that they should be exempt from any quota, and Iraq also has indicated that they think they should be exempt. So we'll wait and see whether they can come to an agreement. If they do, it seems like the burden will fall quite a lot on Saudi Arabia and the other Middle East Gulf countries. So if they do cut production, that might impact the VLCCs trading out of the Middle East. But it's not necessarily a completely bad thing for tankers, because if there's less crude flowing out of the Middle East to Asia, it might mean that some of that Atlantic production, which is ramping up, will then have to move longer haul to Asia, which is a positive ton-mile factor. So we think that there are a number of fundamentals and short-term factors which are going to give a boost to tanker rates during the fourth quarter and into the first quarter of 2017, and we do expect stronger rates over the coming weeks and months. As we've said numerous times, going into 2017, it does seem to be a more challenging market. We continue to see high fleet growth of between 5 and 6%, and the fleet growth is probably going to be even higher than that on the Suezmaxes, which have to absorb around 50 new ships next year. And also, if OPEC does cut, we might see a faster than expected rebalancing of oil markets as well, with potentially higher oil prices and refiners deciding to pull down on inventory rather than importing more crude. So that could impact on crude demand and crude tanker demand a little bit in 2017. But the good news on that is if we have a faster than expected rebalancing in 2017, when we get to 2018, the oil market will be much more balanced. And in 2018 also, the fleet growth will be much lower because there aren't as many ships on order for delivery in 2018. The level of new tanker orders remains very low, and we would expect scrapping to pick up as well because we've had 2 years of very low scrapping, and we're now getting a few ships coming into that age range, where they hit fourth special survey. And we would expect those ships to be scrapped, and that should cause an increase in scrapping as well. So if it is a challenging year in 2017, as many expect, we think it will be relatively short-lived, and we do actually feel very positive about the longer-term prospects for the tanker market from 2018 and beyond. So that's our update on the conventional market, and we'll speak to you again next month.